So let's talk about what we're going to be covering in today's webinar. So first of all, we want to teach you all about the chart of accounts, what it is, how it helps you, and how it's used by QuickBooks to organize your transactions, and then eventually also your financial statements. We're also going to talk about financial statements, what they mean, how they get the data that goes onto them, and how you can read them to know more about what's going on in your business. We'll also talk about the importance of choosing the right account type whenever you're setting up an account. What does that account type do? And also, what does it mean? Those are very important questions to answer, and we will answer them today. We'll also talk about journal entries, what you need to know about them, and just to give you a little spoiler, the answer is not very much, because QuickBooks Online takes care of the vast majority of the journal entries for you, so you really don't have to worry too much about it, but we will talk about the basics of entering those. We'll also talk about some essential accounting terms. So these are things that are good to know about, just so whenever you're working in your QuickBooks Online company file, you'll understand what various terms mean, like accounts receivable and accounts payable, or what's an asset, what's a liability, what's equity. So we'll be talking about a lot of those accounting terms throughout the entire webinar. And then we are also, of course, here to answer your questions as well. So let's dig in and talk about accounting in QuickBooks Online. I'm going to open up my QBO company in the background right here. And let's discuss the chart of accounts, because that's the keystone to this entire class, is understanding the chart of accounts and how it works and how it influences your various financial statements and all that. So you're going to be able to find your chart of accounts at any time by clicking on accounting over here on the left-hand side. And the chart of accounts is a list that makes up all of the different categories that you can apply to transactions as you enter them. Basically, the chart of accounts is your way of summarizing every transaction that enters into QuickBooks, and also every transaction that you have actually had in the real world. Now, some of these accounts are very relatable because we have these actual accounts ourselves, like bank accounts. I think we all know what a bank account is, and when we see a balance right here for that bank balance, we can understand that because we've seen bank balances probably, well, not all of our lives, but for a long time. We understand what that means. That means that's how much money we have in that bank account. But when we look at an account like truck right here, or undeposited funds, or we've got some liability accounts down here, what does the balance mean there? What is that trying to tell us about our business, and how exactly is that set up? Why is that there? These are important questions, and we're going to be talking about those over the course of the entire class, because the chart of accounts is divided up into different sections. And each one of these different sections is for a different type of account. The different types of accounts stand for different things that happen within your business. We have income, we have expenses, liabilities, equity. They all serve a specific purpose, and understanding what each one of them does is very important in terms of getting the most out of QuickBooks. So whenever we enter a transaction, we're trying to summarize an event that really happened in the real world. And when we're talking about QuickBooks, it's going to be financial events, instances in which we spend money or deposit money into a bank account. We're trying to tell QuickBooks where this money is coming from, where it's going to. Now, for instance, let's say I go to an office supplies store and I spend some money on my debit card. Now, in that transaction, my bank balance is going to go down because I'm going to spend money out of my bank account through my debit card. Another account is also going to go up, though, by the exact same amount to account for why I spent that money. Now, if I scroll down, we have some expense accounts. And these expense accounts just summarize why we spend money. And we have one that is actually named office supplies. So whenever I go and I buy office supplies, my checking account is going to go down by the amount of the purchase, and my office supplies account is going to go up by that exact same amount. That way I can track over time how much money I've spent on office supplies. And most transactions that you encounter are going to involve two or more accounts. There's a place where the money is coming from, and then there's a place where the money is going to. And whenever we enter this transaction into QuickBooks, this hypothetical situation where I'm going over to the office supply store and buying something with my debit card, if I were to enter this manually, what I would do is I would open up my Create menu and choose Expense. And on these forms, there's always a place where you can enter where the money is coming from, like your checking account right here. Or if I click my drop down arrow, I could also choose a credit card account if I'm spending money out of a credit card account. And then down here, we'll enter essentially the why of this transaction. Why did we spend this money? In this case, we're spending money on office supplies. So right here, I would scroll down, and if you're looking at this and comparing it to the chart of accounts, these are the exact same accounts that we were just looking at on the chart of accounts. So here I'll select office supplies. And as I enter this transaction, I'm telling QuickBooks that money is coming from my checking account and it's being spent for the purpose of office supplies. So right here, I'll put in my payee, which will be Mahoney's Mugs. And then for the description, we'll enter bought new mugs for the office. And then in the amount field, we'll enter how much money we spent. So maybe we spent $100 on office supplies. And now I'll just record this transaction. And as I do so, the balance for my checking account is going to go down by $100. And if I scroll down to office supplies, we'll go check that one out too. There's office supplies, but I don't see a number here. And it's a little disconcerting to see that because all of those accounts up at the top had numbers. Why doesn't this one have a number? Well, the accounts up at the top are accounts that add up all of the transactions that have ever had for that account ever. Like for instance, right here, this bank balance, $19,895.29, that is the sum of all transactions that ever had in that bank balance. And it just happens that we've received this much more money than we've actually spent. So that's what leaves us with that balance. And it's a good thing to know what that balance is because that's how much money we have in the bank right now. But if we were to apply that same logic to an expense account like office expenses or any of our income accounts, if we added up all the money we've ever spent on office expenses, that's not really helpful for me. Because whenever I look at a report or whenever I look at my chart of accounts for those sorts of things, I want to see how much money I've spent on office supplies this month or this year. That's what's going to help me filing my taxes, is to know how much money I've spent on fuel over the course of a year, or knowing how much money I've spent on cost of goods sold over the course of a year. I don't want to see the entire company's history of this stuff like I do with my checking account or my liabilities. So what accountants have done is they've taken these accounts, they've taken these transactions, and they've put them onto statements. And it's made these transactions and these accounts balances a little bit easier to read. So that way we can narrow down what we're looking at and also add up these numbers and subtract these numbers appropriately so we can get some greater insights into the business. Now, both of these statements are available under reports, and they're always going to be up here at the top under favorites. The first statement we're going to look at is the balance sheet, but the profit and loss is also going to be covered. So let's talk about the balance sheet first. Now, the balance sheet is your company's financial position from one date. So basically, we are saying we're looking at this from the point of view of June 14th, 2018. This is a summary of everything that the business owns and owes as of this one day. It's basically a financial photograph of a business. And so up at the top on our balance sheet, we're going to see our assets. These are the things that the business owns. So we own some bank accounts. We also own some assets right here that are current assets. These are things that we plan on selling or moving around within a year. We've got a truck. So these are all the things that the company owns. We also have a section of the balance sheet which is called liabilities and equity. Liabilities and equity is what the business owes. So what I'm going to do right here is collapse my assets, collapse my liabilities and equity, and surprisingly enough, the two numbers are exactly the same. And it's a little bit weird for people who are first looking at a balance sheet because they think, gee, it's kind of strange that for every dollar that the business owns, it also seems to owe that same amount to somebody. So how is it that a business ever makes money? If everything the business owns is owed to somebody, it doesn't really make sense for the business to be making a profit. How does that work? Well, in the liabilities and equity section, it's broken up into two different parts. The first part is what the business owes to people outside of the business. So banks, creditors, people who have sent you bills but you just haven't paid them yet, those are all considered liabilities. But there's also a section called equity. And equity is what the business owes to the owner. So this is basically the value of the business from the point of view of the owner. So when we say that for everything that the business owns, it owes it to somebody, it actually kind of makes sense because the business can owe people outside of the business and people inside of the business. And whenever the business makes money, the way that this works out is your assets go up because you deposit that money into your checking account, but also equity goes up because when your business makes a profit, who gets to keep that profit? It's the owner of the business, right? So if the owner of the business, if that value is going up for them, that means the business is making profit. And we can see the profit in that equity section. So business is going to owe more and more money to the owner of the business. Now let's go ahead and expand this out because not only do we have the assets and also liabilities and equity, but there are subsections of these different types of things on our balance sheet. So let's examine those a little bit. So on our assets area, we see bank accounts. I think everybody knows what a bank account is. And we also have accounts receivable. Accounts receivable is a record of what customers right now owe us. So if I were to go and look at all of my customer balances, it would add up as a total as $31,968. So that's how much money our customers owe us. We also have other current assets. These are assets that we plan on selling within a year or moving around to a different account within a year. For instance, we have inventory assets. Those are things we plan on selling within 1 year. And then undeposited funds. This is money that we've collected from customers, but we just haven't put into the bank yet. So it's sort of like a place where we put money for now, but we're going to put it someplace else later on. We also have fixed assets. These are big things that the company owns: cars, buildings, land, things that the business owns over the course of several years and continues to get value from those things over time. And we have a total assets of $266,584.25. Now, under liabilities and equity, this is what the business owes. Now, in this section, we see accounts payable. Accounts payable is what the business owes to people who have sent us bills. So utility bills, but also if we've received any bills from contractors or if we're buying some inventory that we're going to pay somebody later for, that's all of our bills that are currently outstanding. We also have credit cards. Here's a credit card with a balance of $350. We owe money on that credit card. And then we have something called long-term liabilities. Long-term liabilities are things that are going to take us more than a year to pay off. So think mortgages, car notes. We've got a small business loan right here. So these are things that are going to take us a long time to pay off. That's what long-term liabilities mean. There's also what's called current liabilities. Current liabilities are things that you owe, but you plan on paying off within a year. Now, all of our liabilities add up to a total of $29,265.60. Scrolling down a little bit further, we see equity. Equity is what the business owes to the owner of the business. So this is essentially the value of the business from the point of view of the owner. Now, a lot goes into this number. First and foremost, we have the net income. That's the amount of money that the business has made this year. So if I were to add up all of our income and subtract all of our expenses and cost of goods sold, that's the amount that I would get for the current year. But what about past years? That's an important metric as well, because we don't want to just know what the business is worth to the owner this year. We want to know what the business is worth to the owner overall. Well, this number right here, retained earnings, tells us how much money came in from previous years. So this is basically the net income from every year before the current year. Now, a lot of people ask me, what sorts of transactions do we need to enter at the end of the year? What sort of year-end journal entries do we need to make? And my answer is always probably nothing, because QuickBooks Online does this for us automatically. Right now, we're looking at this balance sheet from the point of view today, right? We looked at the as of date up here. It says as of June 14, 2018. Well, let's jump in our time machine. And we're going to go look at this business from the point of view of the end of last year. So here for the date, I'll put in the end of 2017. And then we're going to run the report from a different point of view. And then I'm going to scroll down. And down here, we can see that the retained earnings went down. And we have a different net income, because now the balance sheet is showing me the net income of 2017 instead of 2018. And it's showing me retained earnings from the point of view of last year. So that's all of the net income from years previous to from previous to 2017. Basically what happens is whenever we move from 2017 to 2018, QuickBooks will take the amount of money right here in net income and put it into retained earnings. It does it automatically based upon the date that you've entered right here for your company file. So whenever I run this report again for this year, we can see that retained earnings went back up because it put all that net income from 2017 back into retained earnings. No journal entries are involved in this at all. We just are running this report for different dates. Now, the basic accounting equation that's going on here is assets and also assets, where we're going to take the assets and then subtract out the liabilities and equity. And what's left over is going to be our equity. So basically, if we were to sell off everything that the business owns and then pay off all of our creditors, what we would end up with is what the business is worth to the owner, $237 and $318.65. So that's the balance sheet. Now, as you can probably surmise, this number is pretty important because this is what's going to raise the equity year over year over year. Now, that number comes from a different statement, the statement called the profit and loss statement, which I'm going to open up by right-clicking on reports and then choosing open a link in a new tab. And in this new tab, I am then going to click on profit and loss. That way we can look at one versus the other side by side in these two different tabs. So on this profit and loss statement, we notice an immediate difference, which is that the profit and loss statement is reporting to us information over the period of a year right now. But of course, we can change that, which means that it's giving us basically a slice of the business, telling us how much income and how much expenses we've had over a period of time. Like I was talking about earlier, it's not really helpful for us to see all the office expenses we've ever had for the entire company's history. It's better to see it for a year or for a month. The profit and loss statement lets us do that. So here, we're able to see all of the income we've received over the course of this year. And we have a total income of $68,000. And each one of these different income accounts basically stands for a different way that we've made money. And then we also have our cost of goods sold. Now, mostly cost of goods sold is going to be updated automatically because it has to do with inventory. Whenever you buy inventory, your inventory assets go up. And whenever you sell inventory, the amount that was added into the assets account goes over to cost of goods sold and happens automatically. You don't have to do anything with it special. The only time where you would really enter cost of goods sold by yourself manually is if you are paying contractors. So if you're paying contractors, a lot of people will categorize that with a cost of goods sold account. And basically what happens is QuickBooks takes the income, subtracts out the cost of goods sold, and it also subtracts out all the expenses. And expenses are things like overhead. These are things that you'll pay for regardless of how much product or how many services you perform generally. Things like rent, your utilities, you've got advertising expenses right here. And it subtracts out those as well. And what it's left over with is net income. And that's the profit of the business. Now, this number might look familiar because it's the exact same number that also appears at the bottom of the balance sheet. And that's the one number that these two statements share among one another, because this number is basically one big statement. It has a lot of transactions that go into actually building it. So QuickBooks takes all those transactions over whatever period of time you've selected for your profit and loss report, adds them all up, and it gives you your profitability for the business over that period of time. Now, all of these accounts come from the chart of accounts, which is available by clicking on accounting. And here we're able to see all those accounts that we just saw. Now, as you're looking at the chart of accounts, it is divided up into different sections, just like your statements. Up here at the top, we see our assets. And then immediately underneath assets, there are also liabilities. And beneath the liabilities, there is equity. So probably sounds a little familiar because that's the exact same order that they appear on the balance sheet. Scrolling down further, there's also income, there are expenses, and cost of goods sold in the exact same order as the profit and loss statement. Up at the top right, on the chart of accounts, is a new button. Now, whenever you want to set up a new account, you can click that button, and from here, you can set up that new account. you first choose the account type. And the account type is basically you telling QuickBooks what it is you want to track. Are you setting up a new bank account? Are you setting up a new loan, like a liability? Are you setting up a new way for the company's owner to add equity into the business, to add those investments into the business, or take investments out? Are you trying to summarize income that's being made from sales? Are you trying to summarize expenses that you have that you're paying? So basically, you have to think about what it is that you're going to use this account for first. And then based upon that, you're going to set up a new account type from this list. Now, of course, this is a tough thing for people who are new to bookkeeping, because a lot of people really haven't been forced into a situation where they think in the abstract in terms of income, cost, goods sold, and expenses. There is definitely a learning curve here. So there are a couple of things that you can do to help you out with this. Number one is, if you have an accountant, and QuickBooks Online is not intended to replace an accountant at all. It's meant to make it easier to work with your accountant, and hopefully spend a little bit less time having to work with the accountant over time, fixing problems and things like that. But you can actually get your accountant to join your company file by clicking on My Accountant right here. You can invite them through this window, and you can also click on Find a Pro to Help. And from this screen, you can then search for what are called pro advisors in your area. And these are people who have passed certification exams, and they know how to use QuickBooks Online at a high level. So this can be a very helpful resource for a lot of you. I don't mean to give free advertising to the people that we see here on the screen, but they just happen to be in the area, so I'm just showing you who they are. Now, in addition to that, there are other resources that you can take advantage of. First of all, in the handout, and again, this handout is available in the handout section, but it'll also be included in that email that you get in about an hour or so. There is in that handout a little section right here called Account Types Balance Sheet, and it has a QuickBooks type. So these are the types of accounts. Then it also has the description. So basically a rundown of what that account does, what it's used for, and then examples of why you would want to use that. It's got all these for the balance sheet, and then it's also got one for the profit and loss statement right here. So you can use this to also help you understand when to create certain different types of accounts. Those are intended to help you out. So when you're creating an account, it's important for you to consider why it is you're going to be using it. But also it's important for you to consider if you need it at all. I get questions all the time about what accounts should I have on my chart of accounts? And that's not an easy question to answer, because it's going to be different for every business. And the answer that I normally give is, what you should do is consider what's important for your business in terms of making decisions. If there's a metric that you want to measure in terms of your income, cost, goods sold, expenses, things like that, and measuring that is going to give you some insight into how your business is working, or different aspects of your business that you want to accentuate or understand more of, you should have an account for that thing. And you can enter transactions over time, accumulating information about that sort of aspect of your business. That's a good reason to set up an account for anything. Another good reason to set up an account is if you want to track a certain type of expense for tax purposes. So right here on this chart of accounts, for instance, we have fuel account. And if I go down into my expenses area, we'll find that it's auto and truck expenses fuel. Now we have this set up as an individual account because whenever it comes time to file taxes, we want to be able to see how much money we've spent on fuel over the course of the year. Because whenever you fill out your taxes, you can take deductions for either fuel or mileage, depending upon which one gives you the better benefit. So it makes it easier for us if we can just look at our profit and loss report and see exactly how much money we've spent on that fuel in one number. That helps out. So if there's something you want to track for tax purposes and isolate it, having an account just for that thing, very, very helpful. So those are the two main reasons that I always suggest somebody create an account for something. But what I don't want you to do is go crazy with the accounts. And I've seen chart of accounts where people will have an office expenses account, And then they'll also have underneath it a separate account for the amount of money they spend on printer paper, and then a different account for the amount of money they spend on toner, and then a different account for the amount of money that they spend on pens and pencils. And it can get crazy. Whenever you're considering making an account or not making an account, you have to think about whether or not it's going to help you make decisions. And if creating an account is not going to help you make decisions, you probably shouldn't make it. Because what you're looking for is a way for you to look at your profit and loss report and see your business from a very high level looking down. You want to be able to look at it from that bird's eye point of view. So having a cluttered chart of accounts definitely makes it harder to work with in a company file. Now let's go ahead and set up a new account. I'm going to scroll up here to the top, and our business is going to pay a consultant to come in, and we don't have an expense account that we find is appropriate for that sort of an expense. So we're going to click our account type drop-down arrow and choose an account to summarize this expense. So it's expense for consulting. Now, for this consulting expense, we're going to call this an expense. But a lot of people, whenever they're entering transactions, have a pretty big question, which is, what's the difference between an expense and an asset? Because these are both things that we buy. And we buy assets, we also pay for expenses. So what's the big difference between those two things? Well, an asset is something that you buy and you keep it even after you use it. So if we go out and we buy a computer and we use that computer, it doesn't go away as soon as we've used it. We get to keep on using it year after year after year. So if you're buying something that is like that, something that you're going to get value for over time, it's going to be an asset. And you can buy assets. You can enter it as an account, just like I did earlier as office expenses. But if you're buying something that is either going to go away after you've used it, or if it's for a service that's going to be provided for you, those are usually going to be expenses. So in this case, we're paying somebody for some consulting work. So it's going to be an expense. It's a service that's being provided for us. So I'll choose that as the account type. Now we also have a field right here called detail type. So this, and I haven't mentioned detail type at all so far. So it's kind of sneaking up on us here. What does detail type mean? Well, detail type is basically just an additional descriptor. It's a way for us to add a little bit more detail on top of our description of this account. It's not a thing that you should spend a whole lot of time worrying about, because it doesn't actually do anything besides add the detail type onto the chart of accounts, which again doesn't actually do anything. It's just basically, think of it as a description field, even though I know there is actually a separate description field. So from here, what I always advise people to do is just take your best guess. You're not going to get it wrong because there's really no wrong answer. We'll say it's legal and professional fees. That sounds good enough for me. I'm going to name this consulting. You can also enter a description here, and you can make this into a sub-account, which we'll talk about here in a few minutes. Now I'm going to save and close this, and now I can see on my chart of accounts, by the way, you can use this filter area right here to go and find a specific account. I'll type in consulting, and there's the account that I just set up. So now that I've set up my account, if I want to use it, I can go up here to my create menu and I can fill in a transaction with it. I can also download transactions, and I can use that expense account in the category field whenever I'm entering those transactions. But if I wanted to enter it manually, maybe we're going to spend $1,000 on consulting work. We're going to go over to Weisskopf Consulting, spend some money out of our checking account, and down here in the account area, I'll enter consulting. So we'll say that this is for new business consulting, and it's for $1,000. And whenever I record this, and then go check out my profit and loss statement, down towards the bottom in the expenses area, I will see consulting. There's the $1,000. So that's how QuickBooks gets those numbers. It looks at all the transactions, adds up all the balances, and it gives them to us collated and easier for us to digest here on these statements. Now, whenever we're looking at a profit and loss statement, all of these accounts are organized in alphabetical order. But there are additional ways for us to organize these statements and also our chart of accounts. One of the main ways that people do that is with something called sub-accounts. And by using sub-accounts, we're able to see a general category of income or expenses, and then different levels of detail underneath it. So right here we're seeing insurance expense, and by using sub-accounts, we can see how much we spend on insurance as a whole. But we can also drill down and see the amount of money we've spent on auto insurance versus general liability versus workers' compensation insurance. So it's helpful in that regard. If you have different types of expenses within an expense, it helps you out in that way. But the way that it really helps you out is that if we want to, we can choose to collapse this report. Just click on collapse right here on the left-hand side. And whenever I do that, it then collapses all of those sub-accounts. So now I'm only seeing one account for insurance expense. Now this is helpful if you need to give a profit and loss statement to somebody who doesn't want to see all those different sub-accounts. They just want to see how much you've spent in total on something. Very helpful to make the report a little bit easier to read in those cases. But these sub-accounts are set up either as you're setting the account up, or you can also edit existing accounts. So right here, if I go over to my chart of accounts, again, click on new, there is a spot right here where I can select is sub-account. So you can select that box, then click the drop-down arrow and choose the account that you want to make this a sub-account of. So basically, you're choosing the parent account for the account. Or you can go back to an existing transaction like that consulting expense account that I created earlier. And I'm going to scroll down here, and there is consulting. You can edit this by drop-down arrow over on the right-hand side and choosing edit. And then we can change any aspect of this account. We can even change the type or detail type if we really needed to, but we don't in this case. So we'll choose is sub-account. And we're going to make this a sub-account of legal and professional fees. So I'll scroll down into the expenses area, and here we see professional fees. Okay, we'll go with professional fees. And then save and close. What that does is it's going to move the consulting expense account from the place where it normally was down into professional fees. There we go, professional fees, $7,900. And whenever I expand this, there we see the $1,000 worth of consulting added up with all the other stuff. So that's sub-accounts. It's a great way for you to organize your chart of accounts and by extension also all of your statements. Now, for sub-accounts, you can have sub-accounts of sub-accounts of sub-accounts of sub-accounts of accounts. You can actually go pretty deep with these. So if you want to make sub-accounts of sub-accounts, that's fine. You can also make sub-accounts of sub-accounts and so on and so forth. Here are some examples of that. We got landscaping services, and then there's labor and materials that are sub-accounts, and sub-sub-accounts are installation, maintenance, or repair, and all of this. So we're able to see all those levels whenever we expand it back out. And whenever you look at these statements, they're always going to be run on one of two of these accounting methods. Most businesses are on what's called the accrual method, but there are some instances in which businesses are on the cash basis, mostly in construction, but it varies. Now, the difference between these two different accounting methods is pretty big, because with the accrual method, we're able to see on our profit and loss statement the money that we've received from our customers, and it also includes the money that we've invoiced our customers for, but they haven't paid us yet. So even if a customer hasn't paid us, if we are on the accrual basis, we still see that money that we haven't gotten yet as income. And that also goes for expenses. So if we've entered any bills from our vendors that we haven't paid yet, whenever we look at our expenses area or cost of goods sold area, we'll still see the expenses there even though we haven't paid them yet. On the accrual basis, that's the way that works. But on the cash basis, you're only going to see those things that have actually been paid, whether they're being paid to you or whether you're paying other people. Now, what I'm going to do right here is look at my balance sheet on one side, and then look at my profit and loss on the other. On the balance sheet, there are two numbers, accounts receivable and accounts payable, that are important for this process, because what the cash basis does is it takes all of the income that is tied into accounts receivable, and it takes all of the expenses that is tied into accounts payable, and it gets rid of it. Because these are things that have not been paid to us and also things that we have not paid yet. So whenever I switch over to the profit and loss statement, and I switch over to the cash basis, I'll probably find that my income goes down because I have some open invoices, about $31,000 worth. So I'll switch over to cash, run the report, scroll down, and now I can see my total income went down. Not a whole lot, looks like. There are other reasons why why income might not go down or up depending upon the situation. It could be that our invoices are for things that don't necessarily work with income for whatever reason, so that can happen. But if I go down into my expenses area, I'll probably also find that they went down as well, and they did. So basically, the cash basis is just showing you the income and the expenses that have actually been paid, whether they're being paid to you or whether they're being paid to your vendors as well. Now, throughout this webinar, we haven't really seen any journal entries, right? And that's one of the things that a lot of people worry about whenever they start getting into bookkeeping programs. They worry about journal entries, they worry about debits and credits. I haven't talked about debits and credits either. And the reason why I haven't talked about journal entries, the reason why I haven't talked about debits and credits is because you generally don't really need them that much. Most transactions in QuickBooks can be entered very easily by clicking the Create menu up here at the top right and then choosing the type of transaction. So if you're going to send an invoice off to a customer, you'll select invoice. If you've received a bill from a vendor, you'll select bill. So you don't really need journal entries because anytime you enter a transaction, QuickBooks actually enters the journal entry for you. I'm going to go back to a transaction that we entered earlier. This is the expense for office expenses. I'll go ahead and open that one up. Now, whenever we entered this, we didn't have to know anything about debits and credits. All we had to enter is where the money is coming from, where the money is going to. That's it. QuickBooks figures everything else out for us. But there's still a journal entry happening. We're not seeing it, but it's still there. Buried underneath the surface of this transaction, by clicking on More and then selecting something called Transaction Journal, that's going to give us a report that shows us the exact debits and credits in this transaction. Debit right here of $100 to office supplies and a credit of $100 to the checking account. That's the debit and that's the credit. So whenever you're learning about QuickBooks and learning about accounting and bookkeeping and all of that, these are happening all the time. We just don't see them because QuickBooks does it for us. QuickBooks Online is designed for non-accountants. So even if you're not an accountant, it still does all this stuff for us. It just sort of hides it from us. Now this, whenever you look at this, this in terms of how we normally use the words debit and credit, this probably doesn't make very much sense. Because if we're spending money out of our checking account, why is it crediting it? That seems wrong, right? And why is it debiting this account? What does that mean? Well, debit and credit don't necessarily mean going up or down. I know that in our everyday speech, whenever we say crediting account, we usually think of it going up, right? But in accounting, all debit and credit mean are left and right. That's all they mean. Debit means left, credit means right, and that's it. It's just the left and the right side of a transaction. And the debits always equal the credits. Because just like we talked about earlier, how nearly every transaction involves at least two accounts, those accounts are basically recording the same transaction from different points of view, where the money is coming from, where the money is going to, and it's the same amount on both sides. That's why we use debits and credits right here. Now, debits and credits can be entered manually as you record transactions, and that can be done through a journal entry right over here underneath Other. Now, the big question is, when do you need to enter a journal entry? Because usually, so far at least, we haven't needed to enter a journal entry, and I certainly haven't talked about them very much. Journal entries are entered as a way of correcting errors, usually. So if you've been entering transactions the wrong way throughout the year, or you've been using the wrong account for the wrong reason throughout the year, you could enter a journal entry potentially and then move a balance from one account over to another one. Journal entries are also used to record depreciation of assets. And essentially what you can think of for journal entries is journal entries are abstract accounting transactions. These are ways for us to move values around. Journal entries are not intended to be records of money changing hands. If money is changing hands, you need a normal transaction. And the reason why we say that is because journal entries don't appear on reports very well. So if I were to run a sales report and I've been recording all of my sales with journal entries, I'm not going to see any sales on that sales report because sales reports don't include journal entries. Journal entries aren't considered sales, so it's just not going to use them. The only thing where you'll really see journal entries actually having an effect are on your financial statements, and that's really about it. Now, opening up a journal entry, they're very simple to enter mechanically. There's not a whole lot going on here. All we really have to do is record the date that we want on the journal entry, and then the accounts that we want involved in the debit balance and the credit balance. And that's where it gets tough, is the debit balance and the credit balance, because if you don't have a long history in bookkeeping and accounting, you probably won't know which accounts to debit and which accounts to credit in different situations, whether you want them to go up or down. Now, in this case, I'm going to give you a hypothetical situation in which we're going to depreciate our asset. We're going to depreciate our truck asset. So QuickBooks Online is not going to calculate your depreciation for you. There are spreadsheets out there that'll help you do this. There are also depreciation calculators out there, but there are multiple ways of calculating depreciation, and QuickBooks Online cannot do it automatically, but you can enter journal entries that account for that depreciation. So just to give you a hypothetical depreciation transaction, the first thing I'm going to do is record an expense account, which is my depreciation expense. And then as a debit, we'll include the amount that we're depreciating. So if I'm depreciating our truck by $400, I'll enter $400 as the debit. It's also crucial for you to enter a description for your journal entries, because there's no description here. We'll just open it up. We'll see that it's a journal entry, and there's really nothing on the journal entry telling us why this is happening. There's no place for us to put in a product we're selling or a place where money is going to or anything like that. It's just a journal entry. So a description is always very helpful. We'll say that this is monthly truck depreciation. And then in the line immediately underneath depreciation expense, I'm going to click my drop down arrow, and I'm going to choose the account that I want to depreciate. And in this case, it's going to be a sub account underneath truck called accumulated depreciation. And depreciation, the reason why depreciation is done is so that if you make a large purchase, you can put the expense for that large purchase over the course of several years so that you can actually reap tax benefits for more than just the 1 year that you bought it in. So basically, we're moving value out of the balance sheet and onto the profit and loss report so that way we can expense it over the period of several years. And that's what this journal entry does. It's going to lower the asset value of accumulated depreciation, and it's going to increase the amount of depreciation expense on our profit and loss statement. Notice that the description is still the same, so it copies over the description from the first one. We didn't have to enter it multiple times. And now whenever I save and close this, we're going to re-record that journal entry. And now whenever I go over and I look at my balance sheet, I can see on my balance sheet the accumulated depreciation went down. That way we can see the total truck right here, which takes the original purchase price, subtracts out the accumulated depreciation, and here is the amount that's currently on our balance sheet. It went down by the amount of that journal entry, $400. So that helps us over time calculating the depreciation, making sure that it's going onto our statement so then we can use it whenever we're filing our taxes. Now, I also want to look up a couple of accounting terms, because, you know, we've talked a little bit about accounting terms here and there and what they mean. But I'm going to bring up a little slide here that I have in the handout just to go over a couple of them. You know, some of we've talked about already, like accounts receivable. That's the amount of money that's owed to you by your customers. Accounts payable is the amount of money you owe to your vendors. We've also got revenue and income. That's the amount of money that you've made from your sales. And we've also got net income. That's your profit. So income minus expenses. Assets, liabilities, and equity. These are all things that are on your balance sheet. We talked about that earlier. Depreciation. It's where you depreciate an asset over time so you can spread out those expenses over multiple years. There's also reconciliation. We haven't talked about reconciliation in this class, and we don't, but we do have a class about reconciliation. Reconciliation is your way of comparing what's in QuickBooks to a bank statement, also a credit card statement. That way you can see that what you're entering is accurate from a bookkeeping perspective and making sure that everything matches with what's going on at the bank. There's also cash versus accrual basis. We covered that. We also covered, let's see, yeah, we covered depreciation there. Bad debt. Bad debt is something that you can program into QuickBooks, usually through a credit memo. If somebody doesn't pay off their invoice over a long period of time and you want to move that income over into bad debt, which is an expense account, you can do so with that bad debt. So that's also something that you can use transactions for to calculate bad debt. Now, whenever we're looking at these various financial statements, I want to show you a couple of cool things you can do with them. So on the profit and loss statement, you know, we were looking at it earlier and we saw the date range up here at the top. But in addition to just being able to set the date range, which we're seeing up here at the very top, we can also have QuickBooks rearrange the profit and loss statement to give us information about different aspects of our business. So if, for instance, we wanted to see not only our profit and loss statement for this year, which we are currently looking at, but we also want to see it on a month-by-month basis, what we can do is click this Display Columns By drop-down arrow. And from here, you can choose any one of these different metrics to break down your profit and loss. So for here, if I choose months, for instance, and then choose Run Report, now we're going to see our profit and loss report broken down by month: January, February, March, April, May, and then the total. And then you also see a total for each one of those individual months down at the very bottom. So it's a great way for you to break it up. And the different ways that you can look at your profit and loss report in terms of these columns is really only limited by your imagination. Because if, for instance, we wanted to see, say, 1 month of our income, so I'm going to go ahead and put that in, 1 month worth of our profit and loss, but we wanted to see this broken down by week. To do that, click on weeks, and then click Run Report. So now we've got a weekly income and expense report for that 1 month. So you can break this up however you like to in terms of the columns and also the date range. Now I'm going to switch this back over. And up here at the very top, we also have options for comparing another period. Now right now we're seeing all dates. I'm going to change this over to this year to date. Run the report. And now in the compare another period, I can use these options to look at the numbers that we're currently looking at compared to something else. So if I wanted to look at, say, this year compared to the previous period, which is last year, I would look at the dollar change, the percentage of change, run the report. And then now we see January 1st to June 14th, 2018, and next to it, January 1st to June 14th, 2017. And we also see the dollar change, the percentage change for all of those numbers. Very helpful to see how you're doing over a period of time. But there's also an option, this is especially helpful if you're in a seasonal business, for your ability to see how well you did over the course of time this year compared to last year. So if I wanted to instead look at how I did, not just for a previous period, but maybe for, let's say, 2/1/2018. All right, so see how we did in February. Oh, we didn't do very well at all in February. Looks like that's not good. Let's try this. Okay, well, I guess that's a little bit better. It's how well we did from 3/1/2018 to 4/30/2018. If we wanted to see how well we did this year versus how well we did during that same period of time in a previous year, what we can do is click the drop down arrow here and then choose previous period, or previous year rather, and then run the report again. And this allows us to see, instead of just 1 month compared to another month in the same year, instead here it's going to show us March through April 2018 compared to March through April 2017. So we're able to break these numbers down as well and compare different periods against one another to gain more insight about our business as well. So I am going to also look at, hold on, we're also going to look at another metric that you can change about this report, which is that you can add a percent of income, percent of expense on this area. And also, whenever you're looking at sales reports, you can also use percent of row or percent of column. That way you can see the percentage of your sales coming from each one of your different customers or your different products and services. Or you can see what percentage of your total expenses comes from various expenses that you're seeing on your profit and loss statement, where your income is coming from as a percentage as well. So we've got all of those options on this report too. Now, these reports are built upon different data sets, like your customers, your products and services, your accounts, and you can change the data sets that are being used. So right now we're looking at a profit and loss report for the entire business. But if we click on Customize, down here in the Filters area, there is a section where we can basically tell QuickBooks about different things that we want it to use and also not use. So maybe if I wanted to look at my profit and loss for just one customer, so I could see all of the income and also all the expenses associated with that one customer, what I can do is turn on my customer filter, click the drop down arrow, and then choose the customer that I want to see. Then run the report again, and this report will show me all of the income and also all of the expenses that I have entered and associated with that customer. People use this for job costing a lot of the time, so it's very helpful in that regard. So these statements are the keys to being able to look up your company's financial success or problems, because all of the transactions that you enter into QuickBooks are going to go through these two different statements. And using these tools, hopefully you can gain some more insights about where your business is going and also where it came from.